So China continues to be the gift that never stops giving. So of course, the main beneficiary of many of these unending developments around the real estate sector, the banking crisis, the economic collapse are firstly, your mainstream media, and of course, your major YouTubers. So just doing a quick YouTube search, just this two keyword, China collapse, you can see many of these headlines sing a similar story. China's economy may be collapsing. China's economic crisis. China economic collapse. Yuan crash and investors flee China's economy. It's over. China's economy is finally collapsing. And of course, the thumbnails, they use a similar Chairman Xi picture. Is either he looks worried or he looks stern and angry. And you have a fire background, you have the Chinese flag, you have the Chinese geographic size that is on fire and things like that. So I think my role here is definitely not to add fuel to the fire. And of course, for those of you who have been following me, most of you probably know that I'm one of the bigger China bulls. And despite experiencing the huge drawdown over the last two odd years, coming 3 years now, I still remain relatively optimistic, and my portfolio position and sizing tells you the same story. So I hope that I remain intellectually consistent. So on top of just saying that I'm a huge China bull, my allocation on a portfolio level shows the same conviction. Now, moving on to this entire idea behind China's Lehman moment, of course, by having like a 60, 70, 80% overweight of my portfolio into China, I definitely have my own read of the situation as they are playing out. Sometimes it might be economical, sometimes it might be political, and more often times than not, many of the discussion points around many of these Chinese equities are political in nature. People are saying that, oh, what happens if Chairman Xi does something like that, or if the regulator cracks down, or if the company ceases to exist and stuff like that. So of course I can understand many of their viewpoints, but I vehemently disagree, which is why I'm allocating such a huge sum of my capital to many of these names. And I do see tremendous opportunities for people to exploit, especially for those that do have the courage and the balls, if I can put it that way. But anyhow, it has come to my attention that some of my friends and even many of my viewers have sent me DMs on Instagram, on Twitter. Personally, I don't have a personal vendetta. I'm not enemies against Financial Horse as well. In fact, he's one of the strongest or stronger player in the Singapore finance ecosystem. I think his Patreon has quite a substantial number of people subscribed to him. But I definitely do have my own considerations when I read this particular piece, which is why I transformed it into a video, and I wanted to kind of shed some light and different perspective from him. So the title of the blog article is definitely intriguing. China's Lehman moment is here. 9.6% dividend yields. Is this REIT/stock buy of the decade? But with that, I think I also wanted to provide more color to viewers that have been loyal viewers of this channel. So just to provide you some perspective, at least for my YouTube channel, the audience is largely international. And yes, my home base is in Singapore, but I've tried to not restrict myself only to the Singapore market. So a large part of my audience pool, 30% is from Singapore, but I do have a lot of Americans, Westerners that tune into the channel as well. 20% from the US, 5.1% from Canada, 3.7% from the UK. And that is why whenever I make a position or whenever I make a video, I always take into account whoever I'm talking to. And I can't have that same assumption where, I know that if let's say 90% of my audience is from Singapore, I can make analogies and I can draw in past assumptions, and I can presume that most of you are probably Chinese, most of you probably know a little bit of Chinese and a little bit more about China by and large. But when I'm talking to such a diverse group of audience, I tend to be a little bit more cautious. And also, a Singapore-based YouTube channel, which is the fifth person, I think they have quite a relatively large following. They have also coincidentally released a video that I wish to talk about right as of the recording of this video. They have the title, China's stock market crashes again, new investment opportunities. And as you can see, I'm a loyal viewer. I consume their content religiously. But I just wanted to point out a peculiar observation that I had, because whenever I do talk about some of the investments out there regarding Alibaba, Tencent, or some of these Chinese companies, I do have a barrage of comments coming in, particularly I think my Western counterparts that come in to lecture me, to insult me, and to tell me how I'm so stupid of investing or putting capital in the Chinese market. I think it's really just this differences in culture and this appreciation of the difference in thinking and how some of these policy actions are being implemented. But of course, don't worry, I still love my Western counterparts, and you guys are basically the ones that keep spurring me on to create more content, to not really dispel, but really just to provide a different perspective. So that's that. Now, I think to go to the article proper, let's look at what Financial Horse has to say. Financial Horse is also a Singaporean-based creator, by the way, and you'll know why I say that many of these Singapore-based creators, we hold a more forgiving attitude to many of these Chinese equities. You know how everyone regrets not buying more in 2008? They say that if 2008 ever comes again, they will go all in. And when 2008 actually comes around again, everybody is rushing to sell to raise cash. You see the irony? I guess we can all speculate what kind of framing Financial Horse is going to bring us into. So China's Lehman or 2008 moment is here. Well, in today's article, I'm going to share my view on how I think China today is going through a Lehman/2008 style deleveraging, and how this is opening up unbelievable opportunities in China's stocks, REITs, real estate. How exactly to play this is not an easy question to answer, but I think for investors with the right framework and guts, there could be some huge opportunities in the months or years ahead. So just ask the guys who actually bought in 2008. So they will tell you that it was as much about blind guts as it was about macroeconomic analysis. So just this first paragraph, I do have a few differing views. Firstly, I'm going to plant my flag here and say that China is not going to experience a Lehman moment. Let's at least try to stay intellectually consistent here. On one hand, many people like to say that the Chinese government has absolute control over the economy, over the political phrase, and over even how civilians are going to live their life with their social credit system. On the other hand, you are probably expecting for some sort of an absolute meltdown and crash. I think those are of opposite polarities, and they won't exist in the same system. I do believe that the control is some sort of a balance, but I do know that, or at least I do believe that a lot of you will agree that, hey, China is a lot more has exercised a lot more control in terms of how they run the system, whether is it in their economy, in their politics and stuff. So in order for a Lehman-like crisis to happen, the Chinese government has to sign off that check. And I don't think they're going to sign off that check because it's going to look very ugly, not only for the economy, but for the optics of politics where it's concerned. But I do agree to a large extent that there is a very huge level of deleveraging that's happening in real time now. And it has already happened since 2020 when they instituted the 3-rate line policy. So, of course, investors just want to know how to make money and how to invest. So that's a later part of the discussion. Next, I do believe that it opens up unbelievable opportunities, particularly for investors that know what they're doing. And of course, about blind guts, when everything looks pessimistic, when everything doesn't make sense, it's usually this unwavering optimism and blind guts that keep you sane and keep you going. And at least for those of you who have been following my journey, I think how Alibaba has experienced that drawdown, you really need this relentless optimism. If not, I don't know how you're going to sleep well at night. But on the idea of macroeconomic analysis, which he will be going through, I do have my own differing opinions on it, but we'll talk about it later. So China's stocks are cheap. Nobody is denying that. I shared on Twitter this week a bunch of charts showing how cheap China's real estate or stocks have gotten of late. So here's Link REIT, plunged to 2014 prices, trading at a 50% discount to book and a 7.2% dividend yield. This isn't some small cap REIT, mind you. This is Asia's largest REIT by asset size. So here's Singapore listed Hong Kong Land, trading below COVID prices, a 6.3% dividend yield at these levels. So here's ICBC, one of the world's largest bank and bigger than JP Morgan by asset size, trading at 2008 prices, last hit during the depth of the financial crisis, a 9.6% dividend yield at these levels. Here's FXI, the China's large cap ETF, close to 2008 prices. I could go on and on and on, but you get my point. China's stocks are very cheap today and trading at close to 2008 levels. And if you're to allow me to add, this is precisely the embodiment of the idea behind being greedy when others are fearful and being fearful when others are greedy. So I think back in 2008 or even in the 98 financial crisis, I believe many parts of this area, this Southeast Asia region, many of us are hit badly. So I'm just going to pull out two stock charts about the two major I would say, stock market indexes, namely the Thailand and the Indonesia stock market index. You can see that from their peak of 1997, they were trading at around 800 to 900 points. And in the 1998 crisis, they actually trade to a low of 260. So that's, I don't know, that's an 80% drawdown. And right after the 98 financial crisis, for those of you who have the guts, for those of you who have the optimism, you see tremendous amount of return. At its peak in 1997, they were trading at around 700, 725 points. At its trough, and during the 98 financial crisis, it was at 340 points. So give and take, it's also down at least 60%. And right after the financial crisis, even though they have experienced a 08 financial crisis, which also experienced some sort of drawdown, you can see that investors are rewarded handsomely, especially for those of you who have the guts to continue going on. So it's the same logic now. And of course, many naysayers are going to say that this time is different. China is different. China politics is different. Everything is going to be different. And it's really the idea of taking advantage when there's blood on the streets, even though it's also your blood on the streets. China contagion risk accelerated the past week with Country Garden defaulting on their bonds. And just out today, I think Country Garden wanted to issue new shares and new rights to basically raise cash to tide over some short-term liquidity issues. Second, Evergrande filing for bankruptcy. I think I just wanted to put a note here. Evergrande didn't file for Chapter 11 bankruptcy. Evergrande actually filed for Chapter 15 bankruptcy protection. This also means that they are undergoing some sort of restructuring and they want to protect the company from being sued by many of their creditors. So it's a bit different, but of course, Evergrande is kind of a magic cup. It's like a dead fish trying to stay alive, and they are going through many of these restructuring plans and negotiations, and they need time. So which is why they filed for Chapter 15, and they didn't really file for bankruptcy per se. So there is a nuance here. I think it's slightly disingenuous if you are going to just put a blanket statement and say that Evergrande has went bankrupt. And lastly, Zhongzhi, one of the largest wealth manager, also missing payments. This really signals on the entire idea behind a shadow banking crisis, but this is not the main point of this discussion. So this sparked a risk-off for all China or Hong Kong related assets. But truth be told, those are all just symptoms of an underlying problem. They're like bear stearns in 2008. Sure, bear stearns caused stocks to drop, but to say bear stearns caused Lehman and the financial crisis is not accurate. Rather, it was subprime mortgages as the underlying problem that took down the financial system, and everything else like Lehman was just a manifestation of the problem. And I kind of do agree, but I also like to say that the accuracy of this entire discussion around investing in China is a lot more nuanced than to say that this is a 2008 crisis or a Lehman-like moment for China, which I wholeheartedly and vehemently disagree. So what is China's subprime equivalent? So the underlying problem China faces is too much real estate debt. In the early days of 2000s, the debt works like miracle for the Chinese economy. Debt was used to build roads and buildings. This drove employment for the construction sector. Real estate prices went up. Households became richer because of rising real estate prices and spent more. It's a virtuous cycle. After 2008, China supercharged the debt growth to counteract the sharp drop in global economic growth. But you see, debt is like a drug. Over time, the economy builds up an immunity to debt. Inefficiencies built in the system, and eventually, you need ever-increasing amounts of debt to achieve the same level of economic growth. So either A, increase debt exponentially, or B, deleverage. So the decision is simple. Either you increase debt exponentially to fuel economic growth, or cut debt and deleverage. So in 2008, after Xi secured his second term in power, he started to deleverage. Now remember, the real estate debt growth was pro-cyclical on the way up, supercharging the economic growth, which meant that on the way down, it is pro-cyclical as well, supercharging the decline. Less real estate debt growth means less construction jobs, means falling real estate prices, means poorer households due to falling house prices, which cut back on spending. It's a negative reinforcement cycle. But I think I just wanted to add more color as well. Rather than say that they are essentially cutting debt and wanting to deleverage only in 2018 after Chairman Xi secured his second term in power, I just wanted to add more historical context. So this is essentially the full text of Hu Jintao, which is before Xi Jinping, on the 18th Party Congress. And this is back in 2012. So this is more than a decade ago. This is a full transcript, but I just wanted to point you to this very interesting remark that was made by Xi Jinping's predecessor. Hu Jintao said that the task of deepening reform and opening up and changing the growth model remain arduous. So truth be told, the CCP already know that the growth model of just building infrastructure after building infrastructure is not sustainable. So at least from the Chinese political front, they already know that it's a problem long time ago. This was a decade ago. So saying that they only seek to deleverage in the last 3 to 5 years is also not very accurate. But they really haven't found a precise way or an efficient way to kind of replace this growth, which is why it remains like a problem child in every Asian household. They can't really get rid of it, but they're trying ways and means to try to solve the problem. So this is just some additional perspective. Everything was put on pause from 2020 to 2022 due to COVID, as the economic shutdown masked the underlying problem. But the COVID period further devastated household balance sheet as they drew down on savings to meet spending requirements. So in 2023, after COVID restrictions were lifted, China faced the exact same underlying problems as they did since 2018. So what are the long-term options available to China? So let's take a 40,000 foot view here. If China wants to solve their over-reliance on real estate debt, there are 5 options. Keep doing what they're doing, replace real estate with productive investment, replace real estate with consumption, replace real estate with more trade, don't replace real estate. So 1, 4 and 5 are not feasible because this means that inflating the bubble forever, which is not sustainable. Replace with more trade, sure, China will try, but China's trade surplus with the world is already massive. So you're not likely to be able to move the needle meaningfully here. And number 5, don't replace real estate. Real estate in China makes up close to 30% of the GDP. If you let it blow up, it's going to make 2008 look like a child's play, which I agree. So it's not going to be easy, and really the idea of replacing real estate with productive investments and replacing real estate with consumption, this is not the first year that China is talking about it. In fact, they've been talking about it over the, I don't know how goddamn amount of years, over the last 2-3 election cycles. Sorry, not election cycles, the party congress. They've been talking about the same thing. But I'm really a person that look at what they're doing rather than what they're saying. They've been constantly touting on the idea of wanting to go into productive investment, wanting the idea of dual circulation, but they're met with huge challenges. And it's not going to be an easy task. So it's easy to be a roadside economist. I'm trying to criticize what the Chinese government can do or cannot do. But I think in terms of implementation, it's a far cry. Which is why I kind of refrain myself from really commenting on a lot of all these economic projections, macroeconomic analysis, and how the Chinese government should do better. Because truth be told, I don't know as well. And they have the most accurate set of data back in China today. So I hope that they can come up with real solutions and to implement it successfully and efficiently. But evidently, at least the Chinese growth story have been suffering. But at least this blind faith and this blind optimism of China gonna come out alive, this is the end goal, and this is the basis of my assumption. So realistically, there are only 2 real solutions. They have to replace real estate with domestic consumption and new areas of productive investment. So I'm not going to belabor the point. Boosting domestic consumption and having new area of productive investment, it's basically what every economy out there want to achieve. And there is no easy solution moving forward. It's not a pill that you ask Chairman Xi to pop it into his mouth and then magically the economy just comes back alive. That's not how it works. If you understand the solution above, you'll realize this solution takes years to effect. And in fact, it's already underway in the last decade or so. So which means that the inevitable conclusion is that China needs a period of below trend growth in the years ahead as they rebalance the economy towards domestic consumption and new areas to growth, i.e. more pain will come. So what are the immediate options available to China? So let's discuss 3 immediate solutions. Conventional monetary policy, which is cutting interest rate, QE, printing money to buy assets, and fiscal stimulus, giving money to consumers. Again, this is putting on the hats of being a roadside economist. I'm not going to waste too much time there because I really don't see a point in speaking about it. But that being said, China is China. Everything that happens because it allowed to happen. Finally, you're speaking my language. So for commentators calling for a doomsday Lehman style bankruptcy that takes the entire economy down, I'm not so sure we will see that happening. Sure, maybe a 5 to 10% probability, but base case, I think China will manage the drawdown. I will put it at 0.1% probability of a large style bankruptcy happening. In fact, it will be a long-drawn economic slowdown as China reduces its over-reliance on non-productive investment without a commensurate rise in consumption, but it will be a controlled one instead of a big bang. So after Japan's real estate bubble burst, Japan went through a lost decade. The Nikkei went on a downtrend from 89 to 2003, more than a decade. It has never recovered to 1989 highs, not even today, 34 years later. So if my analysis above holds true, will we see the same for China? So how do I make money from this? That's nice and all, but let's go to the important part. How do we make money from this? My base case is that we will not see a singular Lehman moment for China, but we will see a long, drawn-out period of slow or slower economic growth for China. In which case, there are two ways investors can play this. Trade, buy when oversold, sell at the top of the range, or buy dividend stocks while ignoring price fluctuations but collect the dividend. So if you want to trade China, you're probably going to get unbelievable volatility, which means plenty of opportunity for aspiring traders. But what should I do? Buy dividend stocks? So the other way, I suppose, is to buy dividend stocks. But like I shared above, the economy is no doubt in a controlled drawdown mode. So you want to be very careful about what stocks you buy. You want to find stocks where the underlying cash flow is sound and where the dividend is high enough to compensate for the risk. You can find names paying 8 to 10% yield today, which as long as the dividend doesn't get cut, looks very much like a high yield junk bond. And you just collect the dividend while ignoring the day-to-day fluctuation. I think I kind of push back, or I kind of differ in terms of my perspective here. The idea is similar. So here's the key essence. You want to find stocks where the underlying cash flow is sound. Actually, the funny thing is, this idea of investing, or this philosophy behind finding stocks that have underlying cash flow that is conservative, that is easy to project, and that is reliable, this is the basis of investing, and this is value investing. So I don't really necessarily think that you need to buy something of a high dividend yield. Of course, by having a dividend yield, you immediately get back the returns and you immediately see the cash going to your pocket. But specifically so, at least for my investing strategy, because I'm still invested in many of these high-tech companies in China today, I do believe that many of the underlying cash flow is reliable, it's easy to project, and we are going to see it come that is accrual to shareholders in the near future. So maybe the stock price doesn't reflect it, but as long as you believe in the fundamentals of the company and they remain sound and strong, I do believe that in the long run, the market has to price the stock effectively. If not, the company is going to buy back their shares or to issue out dividend. And basically, Financial Horse is recommending, okay, I shouldn't say recommendation, but Financial Horse is only looking at the basket of stocks that already are giving dividends, which cut out this entire guessing stage where you are thinking, oh, would the company reward shareholder? Would the company treat their shareholders rightfully and friendly or not? So that's the perspective. With China, don't ignore geopolitical risks. So let's say that there is a tiny 2% chance of a China-Taiwan war in the next 10 years. And let's say in the unlikely event of a China-Taiwan war, there's a 50% chance of a US sanction against China. That's a 1% chance of catastrophic loss in your China portfolio. So yes, the risk may be minuscule, but the very presence of this risk means that you must position size well. I kind of do agree, you kind of need to position size well, but if you do have a near-term or at least in the next decade outlook of China invading Taiwan, then I don't think you should even be invested in many of these Chinese equities. Heck, I don't even think you should be invested in many of these so-called US American counterparts that has a huge China footprint. I think all of them are going to come underwater with us. Maybe you want to park your money with Raytheon, with Lockheed Martin, those military companies that are going to benefit greatly from this sort of war. You kind of want to stay intellectually consistent. If you do think that there is a huge concern about something like that to erupt sooner or later, then you might want to take a cold hard look at your overall portfolio, and companies like Apple, Starbucks, Tesla, you probably want to relook into those positions again. You can't say that there is a huge China risk for many of these Chinese companies, but yet at the same time discount many of these Chinese risks on these US counterparts that rely heavily on the supply chain, on the demand. So yeah, stay intellectually consistent. If not, I think generally, in terms of how this entire real estate drawdown is going to happen, so I'm still hanging tightly to my optimism on how China is going to come out of this transition phase. And for those of you who don't even have that same belief, I don't think you should be near Chinese stocks anytime soon. But of course, I also understand another class of investors that take the wait and see approach, where they want to see how China is governing themselves in better economic data. But you have to be clearly aware that you are going to give up lower prices. And let's not also forget that because of this entire real estate crisis and whatnot, it's still a lot less scarier when Chairman Xi got their third term, that he got elected in the previous party congress. A lot of these Chinese tech names have already rallied 50%, 100% from their all-time lows back last year. And all that being said, I think in life, everything is a trade-off, particularly so in investing. So you make your own decision. With that, I'll see you in the next video, but more importantly, I'll finally see you on the moon. Goodbye.